funding gap in sub-Saharan Africa runs into billions of dollars that are needed for critical infrastructure, technology development, education, healthcare, energy, transportation, and a whole lot more. But there are institutions around the world that are working to bridge the funding gap by scaling investment flows, in particular to the private sector organization that needs it the most. Joining me to discuss this is Zain Latif, the principal, the partner at TLG Capital. Good evening to you, sir, and we thank you for coming through on the show tonight. Let's raise the curtain on what you're doing at TLG Capital, your interventions in Africa's credit and alternative space. What regions are you deploying resources and why across the continent?
Good evening, boss, and thank you for having me on the show. It's a pleasure to be here. I think to your question, we have a broad mandate to invest across sub-Saharan Africa. The idea very much is to invest in credit, in building up the credit framework of the region, recognizing that the amount of capital in Africa is not sufficient at the moment, the external flows that are coming in, to deal with the demand that is there. So as TLG and in conjunction with our partners at Norsat Capital, we've come together to put $400 million to work in the credit space across sectors in sub-Saharan Africa. And the idea here is to try and scale up and have effects of that money feeding through the system. When you look at a place like Nigeria, obviously one of the more interesting countries in the region, 98% of loans in the country go to 2% of the population, right? That's not good enough. We need to broaden the capital base. We need to broaden investment into folks that need it for investment purposes, because if you can get a functioning SME growth rate in that country and in the region, I think the effects you'll see will be transformative for the younger generation and for prosperity in these countries.
But again, there are risks. I'm sure you're going to tell me that. What risks are associated with African credit markets? What are you seeing on the ground?
So the risk, and that's the biggest challenge, right? I mean, one of the reasons why, if you think about the fact that why hasn't enough capital gone into in sub-Saharan Africa, it's because of the fact that there are significant risks, especially if you're a dollar-based investment house, because the hard currency element, the dollar-based investment, has to be translated into local currency. And then when you want to repatriate your funds into hard currency, you have the exchange rate issues. And this is one of the areas that we're trying to sort of mitigate, is finding out in places like Ghana, places like Nigeria, that are currently struggling to provide US dollars. Ghana, as you know, earlier today just defaulted on its Eurobonds. Those are the things that we actively deal with on a daily basis. And I think that's one of the things that are holding back investors coming into the region, because there's not enough clarity on how you manage and mitigate those risks. As TLG, we've done 31 deals in the region. We've exited about 22. So that just gives us experience and knowledge of how to deal in these more difficult jurisdictions.
But again, do you have strategic areas and partners that you're working with to support Africa's funding gap?
So giving a couple of examples, I think in terms of how we invest and who we were invested with, we love to work with local banks and local financial institutions, because I think one of the key areas that we need to sort of unlock that banks in these regions have a lot of debt on their books to SMEs and so on that's come as a result of COVID. There's been a huge amount of backlog with respect to how do you restructure a lot of that debt to SMEs. And we're coming in to try and rebalance those debts, restructure those debts. And the sectors that we primarily focus on are three: consumer, healthcare, and education. So those are the three sectors that we feel are very important to the rising middle class thesis that we have. We tend to avoid oil and gas and mining because that tends to attract international investors, as you can imagine. But if you can develop the areas that in healthcare and education and financial inclusion, for example, I think you're going to really impact the folks that need it, and you're sort of leaving a lasting impact in the region.
Yeah, but again, we're living in a very interesting times, if I may put it that way. Testing time, more appropriately, we look at emerging global headwinds, higher interest rates, inflation in developed economies, across developing countries as well. You have a stronger dollar on our hands. So how are you intervening across frontier Africa? How much are you being able to put on the table? What's your outlook as next year is concerned with the U.S. Central Bank, the Fed, still talking about more room for rate hikes?
So, the example I like to give, Austin, is it's that if you look at Africa and India, they're very similar, right? In terms of they've had infrastructure issues, there's been cultural issues amongst people, etc., and so forth. But what India's been able to do is leverage its private sector. And because India's been able to leverage its private sector, it's able to deal with all the noise that comes from the stronger dollar, the higher inflation rate, and so on and so forth. It's developed a very strong SME platform. And that's what we feel needs to happen in sub-Saharan Africa. The challenge right now is with all these macro factors that you talk about, including the Ukraine crisis and the war in there that's obviously affected food prices, we don't feel that these are long-term trends that are going to affect the region. I think that what Africa really could do, and especially with the types of investors that we are, is just focusing on giving power to the private sector for ease of business, having a strong legal framework, having a strong independent judiciary, making sure that enforcement and contracts work, and more importantly, just bluntly, stay out of the way, right? Let the private sector and international investors deal with each other, work together, and less government intervention in the ability in these markets, especially in the currency exchange, for example. Until Nigeria resolves its parallel rate with the official rate, you're going to have folks staying sidelines. Braver people like us will come in and will figure out ways to manage and mitigate those risks, but we're far and few between. So we are determined to put in money into the region in the next year. We've closed a number of deals in Nigeria. We're focusing a lot on some of the new banks, banks that are like Fair Money and so on, that are trying to address the credit issue in Nigeria. But we need a factor of 100 to what we're doing in order to move the needle significantly for us to see the results we want to see. But part of that is also government involvement to sort of say, okay, let's help the private sector come in. Let's help the flow of dollars coming into the region. You only have to look at the Nigerian Stock Exchange. You were doing a full report on African stock exchanges. But as you well know, the liquidity of those exchanges make it almost like private equity. If you're looking at the Ugandan Stock Exchange or the Rwanda Stock Exchange, there isn't enough liquidity for people to trade in, trade out, may make investments. So you're always thinking about how do we make these exchanges much more liquid, much more interesting, and unfortunately, you need external investors to come in and really make moves on the market.
Okay, great. Zain Latif, we just call you. Thanks for your bravery doing business in Nigeria and across frontier Africa. It's just that Mo has got a brave heart. Thank you. Nice one. We appreciate that.